Sylvia's Traders Lounge, in partnership with Scope Markets, welcome you to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. Today's guest is Carley Garner, and our theme is how to get started and trade commodities like a pro.
All right, thank you guys for joining in. So I'm going to read out Carley's bio and then we can get right to the webinar. Carley Garner is an experienced commodity trader with www.decalitrading.com, a division of Zena in Las Vegas, Nevada. Carley is the author of Higher Probability Commodity Trading and a trader's first book on commodities. Carley Garner has become an institution in the industry. She has been quoted by the likes of Wall Street Journal, Barron's, and Investors Business Daily. She also writes a monthly column for Stocks and Commodities magazine, and her market analysis is frequently featured on CNBC's Mad Money show with Jim Cramer. Welcome, Carley. We're happy to have you.
Thank you. It's fun to be here.
All right. So
a little early in Las Vegas, but we'll be all right.
All right. So let's just go right into the first question, and we'll be talking about commodities. So when you talk about commodities such as precious metals, oil, and agricultural products, just help us understand how you found your path and preference in trading commodities, and maybe shed some light on commodity trading futures as well as currency futures.
Sure. So from my understanding, I think your followers are generally more Forex oriented. So I'll start with talking about currency futures. We're a big fan of the currency futures markets. It's very similar to Forex, and you're speculating in the euro or the British pound, the US dollar, whichever currency it is that you're trading. But in the futures market, everything occurs on a centralized exchange. The most popular exchange is the Chicago Mercantile Exchange. It's located in Chicago. And on that exchange, traders have access to very liquid, transparent markets 23 hours a day. There are better money protections. There are, like I said, more transparency and that sort of thing. So currency futures are very similar to trading Forex. It's just a different arena. So as long as if you are comfortable trading Forex and you have a trading system or some sort of method that you think works, it can be applied to futures as well. But what I tend to focus on is the grains, energies, metals. As you mentioned, we do a lot of stock index futures trading, so E-mini, S&P, that sort of thing. And what we like to do is we like to use options. We incorporate that into our risk management techniques. So for example, if let's say that we're bullish a particular market and we want to go long a futures contract, we want to buy corn or buy soybeans or whatever it is, we might recommend to our clients to also buy a put option to basically act as insurance to protect the downside, and then maybe even sell a call option to help bring premium in to pay for that. So we try to get creative with it. These types of option hedges are an alternative to just placing stop loss orders. Anybody that's ever traded knows you place a stop loss order and it generally will get hit at the worst time. And next thing you know, the market's moving in the direction you intended it to go, but without you. So we do a lot of option hedges as opposed to placing stops, and I think it can work wonders in just giving traders lasting power, because really, honestly, trading comes down to basically two things, and that's lasting power, being able to ride out trades when you're wrong, or at least being able to survive those trades without account trading losses, and also just keeping your wits about you. It's a mental game, and so proper risk management using options tends to really taper the emotions that come with trading and help you make better trading decisions. So that's kind of what we focus on.
Maybe you can just, for our listeners, maybe you can just touch on, why trading for you and how you decided to settle on trading, basically full time.
Well, I mean, for my bread and butter for a living, I'm a broker. That's how I make my money. But we do, as a brokerage firm, we do offer our clients trading recommendations and guidance and those sort of things. So we're alongside with our clients as far as the markets go. As far as how I got into the commodity markets, to be honest, it was I just kind of stumbled in, probably by pure luck. I thought I wanted to be a stockbroker in life. That's what I thought I wanted to do. And when I actually got into the trenches of that, I decided it really wasn't for me. And so this was something that was interesting. I started looking into it, and I loved it, and mostly because it's a learning experience. It's every day is a little bit different. Every day I learn something new. It's a challenge. We all know trading's not easy. There's no guarantees, and so we're constantly trying to learn new things and adjust to the market conditions to hopefully come out on the right side of things.
Okay, Carley, and now you have written several books, and in one of your books you talk about the essence of, trading higher probability timeframes. So maybe you can tell us about that and where the edge lies when you're day and swing trading commodities. Maybe use a recent example that you have traded recently. Yeah.
Okay, so a lot of traders, they tend to flock towards the idea of day trading. People like the idea of being flat at the end of the day. They feel like it's less risky because they're not exposed to any risk while they're sleeping. The reality is day trading is really, really hard. At least that's been my experience. I haven't seen too many people that consistently make money day trading. I've seen people make a lot of money in a short period of time, but then in the long run, it's really a struggle. And probably the reason being, your trading signals or your system doesn't care if you have to be out of the market by 3 p.m. Chicago time. The markets don't care. The markets are going to do what they're going to do. So if you're living and dying by trading signals that are basically defined by a particular trading session, you're probably missing out on things that would happen positively in the overnight session and that sort of thing. So I tend to lean towards more of a swing trading strategy, depending on the market condition. I think aggressive traders maybe 1 to 4 days. If you're a less aggressive trader, you could maybe put some slower positions together that are intended to be held on to for a month or so. With some of our option traders, when they get into a trade, the time horizon is generally about 3 or 4 weeks. So, I mean, there's really no right or wrong answer. That's the great thing about trading. It really depends on the person's personality, risk tolerance, and what exactly they're trying to do. The markets can be anything you want them to be. And so the reality is each trader has to discover for themselves what their personality is, what they're going to be most comfortable with. Because if you're trading a time frame or a strategy that's not conducive with your personality, you're going to be stressed out. You're going to make bad decisions. So the bottom line is, pick something that works for you. What works for somebody else may or may not be the right time frame for you. But like I said, I tend to prefer swing trading or even position trading. As far as trading ideas, to be honest, the markets have been really weird lately. We've got stocks pretending like coronavirus doesn't exist, and then we have commodities doing the exact opposite. Commodities are just in the basement panicking over the effects of coronavirus. So we're having a lot of weird things going on in the markets. For example, gold and the US dollar are going up together. You don't usually see that. It's usually obviously an inverse correlation. So we're on a lot of the trade strategies and setups that we generally use really honestly aren't working at this particular time because the markets are doing odd things. Luckily, we've had some risk measures in place. For example, a few weeks ago, we sold puts and hogs. I don't know, probably not very many people follow the lean hog market, but market was oversold, sitting on support. Seasonals are coming up. We like to look at things like seasonality. Commodities have particular time frames throughout the year that they tend to rally or decline. So we pay attention to those. Hogs were supposed to have seasonally, they were supposed to have started moving higher. They were oversold, so it looked like a great time to be selling puts. So that's what we did, but we always buy catastrophic insurance just in case. And it just so happens that not long after we got into the trade, the coronavirus scare hit and hogs were limit down for 2 or 3 days. If you're not familiar with limit down in commodities, the exchange sets a price limit for each commodity, how far it can move up or down on a particular day. And once it hits that price limit, it basically stops trading. So in the case of being a limit down move, the market freezes. You can buy it if you want to, but nobody wants to buy at that point, but you can't sell it. So the market just freezes, and sometimes if there's not anybody willing to buy before the close, it just stays limit down, and then you have to worry about it the next day. So it's kind of a weird scenario, something you don't ever want to be caught in, because if you could imagine, if you were long a futures contract, you can't get out, you're just stuck. Because we were short puts, we weren't stuck. We could have traded out, but the put premium had exploded to values that were very uncomfortable. Luckily, we had catastrophic insurance in place, which we always do. So anytime we get into a position, whether it's a long future or a short option, we buy protection. We buy an option, a call or a put against that position, just to make sure if something does go wrong, we're not just out to, being washed out to sea. And so luckily that insurance paid off in that situation. I think actually at this point, after trading in and out of our insurance a couple of times, I think we're slightly ahead on the trade, which is kind of a miracle, because with hogs being limit down multiple days in a row, usually I would say most people probably would have had a rough, rough time at it.
Right. At this point, Carley, maybe you can share your screen, and then you can now visually explain to us, how you actually do that in a practical manner.
Okay, can everybody see that?
Yeah.
Okay. So in my book, I talk about high probability setups. Basically, the premise is we look for positive seasonality. So like I mentioned, each commodity market has different times of year that they generally are strong and weak and that sort of thing. Seasonals don't always work, but they work more than they don't. So you don't want to make a habit of going against them. We also look at the COT report. The COT report it's the Commitment of Traders report. It is issued by the CFTC in the US, which the CFTC is the Commodity Futures Trading Commission. You don't need to really know that. All you need to know is the COT report basically tells us who's long and who's short. They categorize traders into big traders or small traders, and they tell us what the net aggregate positions are. Are they long or short? So what we look for are extremes. If all of the market participants are long, usually the market's ready to correct and sell off. If everybody's short, usually the market reverses and goes higher. So we look at those things. The other thing we like to do is we prefer swing trading over trend trading, which means basically, in a nutshell, looking to buy the dips and sell the rips. So we're not looking for prolonged trends, although, I guess those can be nice, but what we're looking for is extremely overbought and extremely oversold markets. And then we try to play the other side, counter trend trade against it. Now, obviously, there are times where that absolutely just doesn't work, because the market blows through support or blows through resistance, and that's what our catastrophic insurance is for. So with those in mind, today I'm going to focus. The other high probability factor is your emotions, and to be honest, this is the most important. Trading really, truly is a mental game. I've seen it over and over and over again. You can take two people given the exact same signals and the exact same information, and one person will make money and one person will lose, and it's because someone panicked or didn't panic, or it really just comes down to mental. So we're going to focus on that today. I'm going to give you some ideas of like visual charts of extreme greed and extreme fear and that sort of thing. And hopefully I can just give you a couple pointers to whichever strategy that you use. Hopefully you can take this and kind of give yourself a better probability to make money. If you are interested in learning in seasonality and COT reports and all those things that do exist in commodities, by the way, they do. Currency futures also have seasonality, and currency futures also have a COT report. So even if you never trade commodities, if you're still going to stick to Forex, the COT report might help you. And it's a free source. You can find it on multiple websites, and it'll tell you how long speculators are or short in the euro, the British pound. Currently, they're relatively largely short the euro. That's not shocking. Probably getting down to an area where traders are probably too short the euro, and the market might start to reverse. So let's start talking about the only magic in trading is humility and common sense. And I've found that to be true over and over and over. The market always reminds us of this. If you need to get a hold of me, here's my contact information, my email address. We're on social media, Twitter #Carley Garner. Our website's decarleytrading.com. We have, by the way, we have a lot of free information on our website, articles, videos. So if you want to learn, it's a great source. If you have access to CNBC, which is a television channel in the US, I contribute to Jim Cramer's Mad Money relatively often. I write a column for Stocks and Commodities magazine, so if you happen to have access to those sources. And if you want information on commodities, news feeds, research, that sort of thing, you can download our app. It's absolutely free to download. Just search for Carley Trading in your app store. If you want access to restricted content within the app, which is trading recommendations and in-house newsletters, you can sign up for a trial. Otherwise, that is provided to our clients. And once again, these are the books I've written. I would recommend Higher Probability Commodity Trading. It covers trade setups, analyzing a market, and strategy development. Okay, let's get started. So there's obviously, before we get started, I better remind you there's a substantial risk of loss in trading futures and options. It's not for everybody. You can replace that with Forex. It's the same thing. We know it's risky. There's no guarantees. So speculating is easy, but trading isn't. We always hear about people talking, it's easy to say, well, I think the euro is going to go up from here, but it's a whole different story to actually go long the euro and hold that position until it actually pays out. These are speculation and trading are two different things. There are times where I've been absolutely right about where the market's going to go and fail to make money on it. There's been times where I've been wrong about where the market goes and actually still break even. Like in the hog trade I mentioned to you, we're actually still ahead, even though I was dead wrong about what hogs would do in that time frame. So you just never know. It's a tricky game. So one of my favorite quotes is, the key to trading success is emotional discipline. If intelligence were the key, there'd be a lot more people making money trading. And it's hard for us to hear this, it's hard to accept this, but the reality is most people lose trading because they panic, they don't respect the markets, they don't respect position sizing, they trade too big, they trade too much. And it's all, they lose because of human nature is really what it comes down to. So I think I kind of already mentioned this, but emotion's really the most influential factor in success or failure. The inability to keep fear and greed at bay can lead to financial and psychological devastation. We've all been there. It happens to the best of us. Trading is not a 9-to-5 job, which is why, again, when we talk about day trading, I tend to believe that day trading, the idea of day trading anyway, kind of lulls people into thinking that it is some sort of 9-to-5 job, and it's not. The markets are moving 24 hours a day. There's no way to get around that. Even if you're day trading and getting flat before the close, you're probably cutting your strategy short. Like you're getting out of trades in the middle of a signal, so on and so forth. And a lot of people paper trade for years and years. I talk to people that's their career paper traders. Paper trading, in my opinion, is only minimally useful. I mean, it's great to get used to the trading platform, to understand how profits and losses are calculated, that sort of thing. But as far as owning in on your trading skills, the only way to really do it is with real money. With that said, as you know, in Forex, you can trade very small lots in Forex. Futures has something similar. Futures has what's called micro contracts. There's micro gold, there's micro S&P, there are microcurrencies. So you can trade very, very small contracts. That way, you're not really paper trading, you're paper trading with a little bit of skin in the game. That way you're not gonna ruin your life by losing money while you're learning, but you're going to have the ability to practice trading with a little bit of emotion involved, and so it makes a big difference. So obviously paper trading is a lot easier than live trading. We all know that. Paper trading, it seems like you can't do anything wrong. It's extremely easy to predict market price, but that's because there's no emotion. And I talk to people all the time that tell me, well, I think crude oil is going up from here. And then 2 months later, they say, I told you crude was going up, and they're right. Crude rallied $10, $15 in that time frame, but it's so much easier to say crude's going up and not have any money at risk, not have to worry about stop loss orders or hedging yourself or the money that you're risking. All of those things it's an illusion. Just because you're right about crude oil going up doesn't mean you could have profited from it. It's a whole different ballgame. So a few things to just keep in mind that work against traders. Again, let's say we believe crude's going up, and let's say that we're right. Even if we're right, if you bought call options, you're going to be hurt by time value. If you sold put options, you might have been forced out due to volatility before the market went your way. If you traded futures, if you went long a futures contract, you might have been stopped out, or you might have ran out of margin money or forced liquidated by your brokerage, or you may have just talked about it, never actually entered the trade, or you could have panicked prematurely and liquidated your position. So all of these things are standing in the way of making money on an accurate market call. And all of those things are tied to emotion. So what we need to do is prepare for anguish. Paul Tudor Jones once said, "Every day I assume that every position I have is wrong." And I try to keep this in mind every day. It's easy to get complacent, especially if things are going well and the markets are moving your way, everything's going as planned, but we should always keep in mind that odds are we're going to be wrong. So when you enter a position and while you're managing a position, assuming that you're wrong kind of puts you in a better mindset to actually truly manage that position properly. So I kind of compare this to trading is a lot like being a doctor in a way. I mean, obviously in most ways it's not, but in one way it is. Not everybody is capable of dealing with blood and the things that come with being a doctor. Similarly, not everybody is capable of dealing with the stresses of trading. So unfortunately, it's not something that can be easily learned. We can't read books or watch webinars and learn how to manage our emotion. It's something that is within you, and it takes a lot of practice. Hopefully, if you're lucky, you're born with it. Otherwise, it takes a lot of practice. And the only way to do that is by actually trading, unfortunately. The markets are mean. If you trade long enough, they will probably make you cry. I've seen grown men cry. It's not fun. And there's really no exceptions. So just kind of prepare for the anguish and know that it's always possible. I don't know if any of you are familiar with optionsellers.com. I mentioned that on this slide. They were a CTA in the US I guess it was 2018, the fall of 2018. They were a CTA is a commodity trading advisor, meaning they're managing money for other people. They had been around for years and years. They were well known. They were well respected. Everybody thought they had a pretty good idea of what they were doing. And they did really well for a long time. And in the matter of maybe 2 weeks, maybe 3 weeks, they blew out their entire fund. And we're talking like millions and millions of dollars. What happened was they were short natural gas calls and short crude oil puts, and they had no insurance, they had no hedge. When things started to go awry, they just kind of sat there with deer in the headlights and wiped everything out. So afterwards, in the aftermath, the trader for that fund made a YouTube video, and it's kind of infamous. If you Google it, it'll probably pop up, where he was apologizing to his clients and crying. So what I like to remind myself of that situation when things start getting a little bit rough, we should always make sure we have hedges in place. Never underestimate the market. It can always get worse.
I remember I watched that video.
You do remember that?
Yeah.
Yeah, it was tough to watch for everybody. So again, before entering the market, we should always assess the major areas of support and resistance, where we're going to place our stops. Although I'm not a fan of stops, I prefer to use options, but where you're going to place your option hedges, that sort of thing. And the reason being, you should determine what a hypothetical worst case scenario is. We never know what the worst case can be. It can always get way worse than we ever imagined. But if we at least have something in our mind as to what the worst case might be, that gives us an idea of whether or not we're equipped to actually put that trade on. If the thought of the worst case makes your stomach churn, that trade's probably not for you. Just move on to the next one. No reason to have undue stress. If you're stressing yourself out, you're going to make bad decisions. There's really no way to get around that. And once that happens, if you start making bad decisions and you start losing money, it triggers destructive behavior, revenge trading. We've all done it. I lost my money, so I'm going to double up and I'm going to make it back plus some. You trade too many contracts, you get impatient, etc. So I would just want to take a look at a couple of charts here to get kind of so we can visualize what we're talking about. My friend Jim Cramer always says no one has ever made a dime panicking, and that's absolutely true. In my opinion, I believe traders should always, like I mentioned, buy catastrophic insurance, have a hedge so that if something really ridiculous does happen, you're not that person panicking at the worst price and getting out. If you have a hedge in place, you can still lose money, obviously, but you know what your risk is. It's limited to a specific amount, even if it's kind of a large amount. At least you know what that worst case scenario is, and you sleep at night knowing that, let everybody else panic and wash the market out, and then you have that lasting power. You'll still be there to talk about it. If you have no idea what I'm talking about when I'm talking about hedging futures with options and that sort of thing, there's free videos on our website that talk about all of these types of strategies. So this is the stock market, or the E-mini S&P, in December of 2018. At the end of the year, it took a really, really big hit for really, honestly, no apparent reason other than everybody started to panic and sell. The problem with, unfortunately, obviously the best case scenario would be not to be on the wrong side of that market. If you're short, it was fabulous probably. But if you were long, you did happen to be in the market at that time, the worst thing that you could have possibly done is panic and sold at the lows. We all know that to be true, but it's the hardest thing not to do. So if your insurance is in place beforehand, you're probably not, you're a little bit sad because you're losing and the market's going against you, but you're not panicking, and that makes a huge difference. Imagine panicking and getting out of the S&P at 2350. 2 days later, it was 150 points higher. That's a $7,500 difference in just a couple of days. So you can see just how painful it could be to flush your positions down with the rest of the market. So lasting power is key. It's really hard to overcome poorly timed liquidation. So another thing to be kind of aware of in the market is markets get greedy. In 2018, we saw crude oil rally, and there was no real good fundamental reason for it. There was no catalyst. It just kind of moved higher. Over 10 months, it rallied $23, and crude oil, that's a pretty big move. At the time, if you would have looked at the COT report, you would have saw there were, I think it was the largest net long position in the history of crude oil. So in other words, there were more people long crude oil than there ever had been before. So that was probably a good sign that if the reality is, if everybody's already long, if everyone's already bought, you kind of just run out of buyers, because who else is going to buy if everyone's already in? It's really that simple. And so everyone was greedy. Once the last buyer was in, the market fell $32 in 2 months. That's $32,000 per oil contract. That's a lot of money. Yeah. On a side note, there's a mini oil, which is great. It's half of the regular crude oil size, so that's a little easier for people to manage. And on an even better note, the exchange is going to be listing a micro crude oil, which will be a tenth the size of the original. So it'll be a lot more accessible to smaller traders. So that's going to be really a great product. But again, keep an eye on the COT report. If you want to learn about the COT report, we have a video on our website. You can learn all about it. It gives you some pretty good clues. So here's just a couple of quick tips that I've learned throughout the years to kind of keep emotions in check. This is actually a quote from Thomas Jefferson. Nothing gives one person so much advantage over another as to remain always cool and unruffled under all circumstances. And that's absolutely true. The way to do that is to hedge with options, in my opinion, but here's a few mental tips as well. So actually, we already talked about this. Some people are just born magically with the ability to control their emotions. Most of us have to learn it. But before you sit down to analyze the markets, look at your trades, look at your trading account, take a few moments to relax and clear your thoughts. This is This is important. It seems silly, it seems trivial, but it really is important. Forget about anything else that's stressful in your life. You don't want to bring your relationship stress or your family stress into your trading. Trading's hard enough. The worst thing you could do is bring the outside in. Take a few breaths. If you're unable to get a relaxed and rational state of mind, you really shouldn't be trading at all at that point. There's nothing wrong with taking a day off, taking a week off, taking a few months off. If you're not in the mindset to trade, don't do it, because trust me, it's just going to get worse from there if you're not ready, if you're not prepared. So losing money is not fun. It's a painful experience. To mitigate the impact of human nature, but I suggest looking at prices, not values. So for example, if you're trading multiple contracts in corn or crude oil or whatever it is, don't look at your profit and loss. Don't look at, okay, I'm up 500, I'm down 1,000, whatever the case is. Look at on a per contract basis, I'm up 10 cents, I'm up 30 cents, I'm down 40 cents. Look at it on a per contract basis based on price, not values. If you start looking at your P&L, you're going to get a little bit rattled. So focus on percentages of probability. Put the probabilities in your favor by using the COT report, seasonals, some of the other support and resistance, some of the things that are, the nucleus of your trading strategy. Don't focus on money. That's where things go wrong, because we work hard for our money. Nobody wants to lose, and nobody wants to even think about risking their hard-earned money. So think about it in points and not money, pips if you're trading Forex. And be confident. If you've worked hard and put a trading strategy together, you've done your homework, you probably realize that you have some sort of an edge. Otherwise, you wouldn't be looking to trade that strategy. So be confident in that strategy. If you've put the work in and you've found an edge, go with it. Confidence gives traders the courage to pull the trigger and works to prevent panic. The worst, well, not the worst thing you could do, but a bad thing is to not have confidence. So you have your trading strategy, a signal comes up and you don't take it because you're scared or you're not confident. And of course, that's the one that works out. And then you might skip the next one and that one works out also. So then by the third time, you're feeling pretty confident, and that's probably the one that's not going to work. So trying to cherry pick or pick and choose which trades you want to take generally isn't the best way to do it. You generally just keep shooting. It's like in basketball. If you're in a slump and the ball's just not going in the hoop, just keep shooting. As long as you're managing your risk properly and your margin isn't an issue, keep going. All right, so we already kind of talked about this. Paper trading, in my opinion, is a waste of time because it ignores emotions, but you can trade micro futures, microcurrencies, micro gold, or mini grains or mini currencies. Those contracts are small enough, just to give you an idea, the margins on those are less than 500 bucks. Most of them are like $200 or $300. So it's a very low margin, low risk. You're not going to make or lose a ton of money. You're not going to get rich doing this, but the idea is to learn with a little bit of emotion involved. Sound mind and body are a package deal. Physical activity stimulates various brain chemicals that may leave you feeling happier and more relaxed. That's according to the Mayo Clinic. So in a nutshell, take care of your body and take care of yourself. Again, I know it sounds completely unrelated to trading, but it truly is not. It makes a difference. If you're sleeping properly, if you're exercising and eating properly, you're going to feel better. You're going to make better decisions. You're going to have more capacity to learn as you're studying the market. And one thing that I find that too many people do is they put too much faith in the gurus because someone's on TV or someone's in a magazine or on the internet and has a bunch of followers on Twitter. They assume that that person is smarter than they are. They know something, they have some sort of edge. And so they rely on that information way too much. The truth is nobody has a crystal ball. Nobody knows what's going to happen tomorrow. Everybody's trying to beat the market, and we're all vulnerable of being wrong. So if you hear something on TV or in a trading forum, don't just blindly follow it. Don't just blindly execute the position in your trading account. Do your own homework. If you still agree with it, then by all means, go for it. But unless you put your own time and effort in and fully understand what's going on, you're going to be in trouble, because if that trade goes wrong, now you're relying on this third party to tell you how to fix the issue, and they're probably not. They'll probably just disappear. That's the thing that happens on these. With the internet, people can say whatever they want, and then if it doesn't work out, they just disappear for a little while. So don't be that guy. Always make sure you do your own homework. If you get some ideas elsewhere, like I said, it's fine. Just make sure that you can confirm that with your own research. So trading less is more. And when I say that, I'm talking about trading fewer contracts, trading smaller sizes, or maybe even trading less per week or per day. If you're taking every single, let's say that you're taking all of your trading system signals, but you're also taking additional signals because maybe the signal almost lined up, but not quite, but you don't want to miss it. Don't do that. Be patient, wait for your everything to come into line, whatever it is you're looking for, and then go. But don't overtrade. It's the worst thing that you could do, especially in today's world where a lot of the commissions are a lot cheaper than they used to be. People just kind of assume they can trade without worrying about it. They don't have to worry about volume, but that's absolutely not the case. And people think that trading one lot is a waste of time, but I'd like to point out that it really only takes a profit of $50 per day to make $12,000 US dollars a year. $50 a day is a $12,000 profit. So I'm not saying it's easy to do that. It sounds easy, but it's not as easy as it sounds. But what I'm trying to point out is you don't have to trade 1 million contracts at a time or be really aggressive to make a little money. If you had a $10,000 account and you made $12,000, you doubled your account in a year with only $50 a day. So you don't have to take big risks and trade big size. So the whole point of our discussion today is to talk about playing the odds and putting the probabilities in your favor. But even if you do all of the right things, even if the seasonals are bullish, the COT report suggests everybody's short, the selling should dry up, we're sitting on long-term trend line support, even if all of those things line up, it doesn't necessarily mean the market's going to do what we think it's going to do. You can put the odds in your favor all day long, and it's not a guarantee. It's a shift in the right direction, but it's not a guarantee. So come to grips with the reality that putting the odds in your favor isn't always enough. The market's going to do what it's going to do regardless of what we think it should do. Realizing this is going to help you mitigate the mental impact should you be in the wrong place at the wrong time. For example, when we put our hog trade on, everything lined up, but we didn't foresee the coronavirus blowing up like it did. In fact, they weren't even talking about coronavirus when we put the trade on. So we can't see the future. We don't know what the headlines are going to be. So even though we did everything right, we can still come out a loser. You just have to accept that and know that going in. Don't beat yourself up over it. So in conclusion, there's no holy grail to trading, but being humble goes a long way. Don't assume you know what the market's going to do. Even the best traders struggle to keep their win-loss ratio above 50%. So that's hard to believe for some people. Most people are looking for perfection. They want to be right on 80, 90, 100% of their trades. Probably not going to happen. Now, if you're an option seller, like a lot of our clients are option sellers. That's a strategy that we kind of endorse. Your win percentage is going to be a lot higher. Option sellers sometimes win 80, 90% of their trades, but the problem with the strategy is, and where you have to manage your risk, the 1 out of 10 trades that you lose money on can be a really big loser that wipes everything else out. So it's give or take. On the flip side, trend traders probably are only going to make money on 20% of their trades, and they're going to lose on 80%. But their strategy is they want to hit home runs on that 20% that engulfs all the losses of the 80%. So just understand what your strategy is and understand what the realities are, and that way you're mentally prepared going in for what to expect. And one thing I've learned over and over and over is never say never. There's really no limitation to an irrational market. I mean, look at the S&P right now. The stock market keeps going up beyond everybody's rational expectations. Sometimes those things happen, and so you have to trade accordingly. We can't trade what we think should happen. We have to be mindful of what is happening, regardless of how silly it might be. It can always get worse. So I appreciate everybody listening. If you have any questions, or if you want to just learn more about higher probability trading or anything else about commodities, you can visit our website, thecarleytrading.com.
Right, Carley. Thank you for that presentation. I now welcome my colleague, Dennis, to give us a rundown on a few follow-up questions.
Okay.
Okay, thank you, Carley, for the presentation. So many things have come out clearly. So basically, the first question that I would want to ask you is, assuming that someone is completely new to trading and specifically, not on specifically commodities trading, and then
Okay.
yeah, and then you're telling them that hey, it's possible to trade oil, it's possible to trade natural gas. So no one wants barrels of oil delivered at their doorstep. So how are these instruments structured in it so that we as retail traders can be able to trade? Can you kindly elaborate on how they are structured?
Okay, so I think I can answer that question. So these products are futures contracts, which is a little bit different. I know overseas, a lot of people are trading commodities basically through a forex broker in what's kind of a synthetic market. So in the U.S., we're offering futures contracts, which is far different because futures contracts are tied to the underlying. So let's say, for example, we're buying a crude oil futures contract. That contract is written with barrels of oil as the underlying asset. So it's actually tied directly to the commodity. And in theory, nobody does this, but in theory, if you actually bought a futures contract and held it all the way to expiration, you could actually take delivery of that commodity. Not in crude oil because it's a dangerous product, but in corn, like if you bought a corn futures, held it all the way to expiration, you actually would take delivery of 5,000 bushels of corn. So because the futures markets are so tied to the underlying cash commodity, the pricing is very efficient. Now, in the short run, pricing can be a little bit volatile. That's just how price discovery is in any market. But in the long run, they're tied together, and so it's a very efficient means of price discovery. Now, as far as getting involved in the markets, it's really simple to open an account. Everything's electronic. And once you open an account and fund it, every broker is a little different, but the minimum account size at a lot of places are $2,000 to $5,000. So with $2,000 to $5,000, you could get started in commodities. If you did start with that amount of money, you'd want to trade the micros and the minis. Keep it really, really small, and that way you could kind of just practice before you actually jump in. But as far as the speculating goes, most commodities trade 23 hours a day. There are options against almost all of them that also trade 23 hours a day, so you have the ability to hedge if you want to. Everything is done on margin. The margin for each market's a little bit different. Most of them are between 1,000 and 3,000, depending on what you're trading. But just to give you, let me take a specific contract, and I think that'll give you a better idea. So in crude oil represents 1,000 barrels of crude oil. So if you go long a futures contract, you're basically controlling about if crude's valued at $60 a barrel, you're basically controlling $60,000 worth of crude. The margin on that contract's about $3,000. So for about $3,000, you're making or losing money based on $60,000 worth of oil. Now that's a lot of leverage. Maybe probably too much leverage, because it would only take a $3 move in crude oil to wipe out your entire 3,000. But that's why using options and other hedges are going to hopefully take some of the volatility out of the market. But that's a whole different discussion. So hopefully that gives you a better idea of how it works.
Yeah, thank you for that, Carley. And now when you talk about high probability trading setups, basically this means that these are setups that have a high chance of working out. So what criteria do you use to determine that the setup is it's a high probability setup? For instance, do you have like a checklist, something?
I do, yeah. So what I'm looking for is a couple of things I've already mentioned today. So I look for seasonals to make sure the seasonals line up. What does that commodity normally do this time of year? I look at the COT report to make sure that speculators aren't overloaded one way or the other. But then I go to technical analysis and I look at the chart. So what I'm generally looking for is just basic. I like to keep things simple. I'm looking for basic support and resistance, trend lines, that sort of thing. And then I also look at the RSI, which is a technical oscillator. It's relative strength index. and I look at Williams percent R. To be honest, everybody always wants to talk about which oscillator you use. Do you use stochastics or MACD or whatever the case is? To be honest, and this is my opinion, other people will tell you different, but I believe oscillators in the long run are all going to perform basically the same. They're all telling us the same information, what the market has done, what the trend is, you know, that sort of thing. Some of them are quicker and some of them are slower, but in the end, if you looked at probably a 5-year period, I bet they all kind of perform the same. So with that in mind, I use the Williams percent R as kind of a get ready, because I'm looking for overbought and oversold. So if Williams percent R becomes overbought, then I look to make sure all of my other checklist items are correct. And from there, I watch RSI. Once the RSI also becomes overbought, then I start considering that to be a viable trade. So I use Williams percent R as a kind of a get ready, and then the trigger is RSI, assuming everything else lines up.
Thank you for that, Carley. In fact, you even answered the next question I was about to ask about indicators. So that was quite an adequate response. So Carley, what basically do you think are some of the common mistakes people new to trading make, and you would advise them to not make those mistakes?
Sure. So really the biggest mistake is trading too much. They either trade too often, or more importantly, and the biggest thing is they trade too much. So for example, I mentioned the margin on crude oil is $3,000. So if somebody has a $10,000 account, they probably want to only trade one crude oil future with some option hedges, and they might even trade a mini future, which is half the size of that. So it would be a margin of 1,500. But unfortunately, what people tend to do is if they have a $10,000 account and the margin is 3,000, they decide they want to trade 3 contracts just because they can. But it generally does not work out very well, because what's happening is when you're using that much leverage, when you're utilizing all of the margin in your account, you're fully leveraged. And when you're fully leveraged, your room for error is basically 0. So unless you pick the exact high or the exact low and your trade goes perfectly, you're probably going to end up with a margin call or some sort of issue that forces you out of the trade prematurely. So the reality is trade less, give yourself lasting power, keep hedges in place so that if you are wrong, you can either write it out or you can simply move on to the next trade without too much damage being done.
And Carley, is liquidity normally an issue when it comes to some commodities that one wants to trade?
That is an excellent question. So there are liquidity issues if you go into some of the unpopular markets. So commodities it's a whole different ball game from stocks. So in stocks, there's thousands and thousands of liquid stocks to trade. In commodities, there's really only I'd say about 15 markets that anyone really has any business speculating in. So stick with the major commodities. So the grains, corn, wheat, soybeans, the energies, natural gas, and crude oil, the metals, gold and silver. Stay away from things like palladium or platinum are really thin, oats, so just make sure, look at an easy way to look at it is if you pull up on a quote board, you can look at the bid ask. If the bid ask is reasonable, then there's probably a decent amount of liquidity, and then look at open interest and volume and just make sure that you're not trying to trade something that's only trading a few hundred contracts a day. Like I would say you probably want to try to stick to something that at least has 5,000 to 10,000 volume per day. And I mean, to put that in perspective, the E-mini S&P trades 1 million contracts a day or more. So if you're trading something that's only trading 5,000 times a day, you want to kind of be a little more cautious. But if you stick to the major commodities, liquidity isn't an issue at all. Everything's pretty liquid. Even the options are relatively liquid. The exchanges have market makers that provide liquidity, so it's really not an issue for most commodities as long as you stick to the major stuff.
Okay, thank you for that. So stick to the major stuff, guys. So Carley, since you're in the brokerage space, I can't just let this question slide. And the question is, can you please shed some light on what one should look at, especially someone who is new to trading commodities, starting out, when they're looking for a broker, what should they look out for?
Okay, so that's a wonderful question. Thank you. So there really are all types of different brokerages. Most brokerages specialize in a particular type of customer. So for example, there's some brokers out there that specialize in day trading accounts. There's other brokers that specialize in options trading accounts. Others that try to do everything, but the ones that try to do everything generally are not very good at anything. So that's kind of how it works out. So there's the one thing that people always pay attention to is commission, and they tend to just go pick the cheapest because that's how our brains are programmed to work. But I really caution people from doing that. Obviously, I'm a biased opinion because I am a broker, but you really do get what you pay for. I'm not saying find the most expensive broker, but find a broker that meets your needs, whatever that trading strategy is, and has a reasonable commission rate, but not, you don't want a bargain basement rate. And the reason I say that is this. If you go to the discount brokers, there's guys out there that will charge very little in commission. They only make a couple of pennies when someone trades. So if their customer trades a futures contract, the broker might make 1 or 2 pennies because they're offering such a low commission rate. So at that commission rate, those brokers provide zero service. They don't answer their emails in a timely manner. I mean, if they do answer, it might be a week later. They don't pick up their phone. It's just how it is. You get what you pay for. So for professional traders, that might be okay, but for the average person that's not a professional and might need a little help occasionally, that's not okay. I mean, just imagine if you have a trade on and your internet goes down, or you're having some sort of technical issue, or you simply just have a question and you can't get anybody on the phone. Meanwhile, your position's making or losing hundreds or thousands of dollars, and you know what I mean, you feel out of control. So don't worry about saving a couple pennies on commission. It's just not worth it. With that said, a good brokerage will be somebody that fits your strategy. So for example, if you're wanting to trade options, make sure in advance that you speak to that brokerage and ensure that they offer option trading of all types. So some brokers don't allow spread trading, some brokers don't allow option selling. And if that's part of your strategy, you want to make sure you're not opening an account with a broker that forbids that. So always just make sure you're finding a broker that's not necessarily a one size fits all, but one that works for your particular strategy.
Thank you, Carley.
You're welcome.
Right. Carley, as we conclude, maybe you can give us a hint of the book that you're working on, and if guys can actually purchase it on Amazon.
Okay, so I'm writing a book on option trading. The very first book that I wrote was titled Commodity Options, and it was released in 2008. This book takes that book and just completely revamps it and adds to it, because I've learned a lot from 2008 to now. I've learned a lot of different things, and so I've added a lot to it. So it's basically going to cover commodity option strategies from A to Z, butterflies, condors, all of those sorts of things, in addition to, I mean, I know you can just Google on the internet what is an iron condor and get the answers, but this book goes way beyond that. It takes that, you know, it defines it and it shows you, but then it takes you through an example, and then it gives you tips and tricks on what could go wrong and how to adjust that and that sort of thing. So we're really excited about it, but it is way more work than I anticipated. For example, my book, Higher Probability Commodity Trading, is about 270 pages. I kind of anticipated this new book to be in that ballpark. And so far I'm about 100 pages over. So it's about 380 pages right now. And I'm not even done. So I'm still working on it. My goal is to have the rough draft done by the end of the month. And if that's true, we should have it out by late spring or early summer this year. So that's kind of the time frame we're hoping for.
All right, and so for your free market analysis and your trade ideas, we can find them on your YouTube channel, because you periodically do that.
Yeah, so yep, you can, yeah, that's a good point. You can go to our YouTube channel, and we do little mini clips about once a week or so on different commodity markets that we're analyzing. If you go to our website, you can sign up for a free trial of our newsletter. So if you want to inform, like written form, you can do that. But YouTube's a great source. That's a good point. I should add that to my slide.
All right. So thank you very much, Carley.
Thank you. Appreciate it.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.